Good afternoon, everyone. What an outstanding turnout. It gives me great pleasure to welcome you all to Bowmans today for what should be quite an interesting engagement at a very important time in the evolution of the South African electricity sector. It's also an exciting time for us as Bowmans. We've grown. We've grown probably into the biggest and probably most capacitated energy and infrastructure team on the whole continent. And we've got a dynamic group of people that has joined us, and we're excited to have them as part of our team. There'll be a lot of talking today, so I will spare you long introductions. And without further ado, I'll invite the joint team from Bowmans and Cresco, the market operator, to lay out the roadmap for the discussion today. Hope it's a fruitful discussion. Thank you.
Good afternoon, all. A bit casual today. It's a bit hot in Joburg, as you can see. So thank you for joining us. I think we had 330 people register, a lot online and a lot in person. So clearly the topic has some interest, more than the gas one last week, which is also available for those of you who are worried about the gas cliff. But just to build on what was said, I think Bowmans has done great things to have the old, whatever that company was called, team join. And I think from the team that we've always worked with across their various organizations they've worked with, they've always been cutting edge, if you can do that term with lawyers, in terms of developing policies, thinking and that. So well done to Bowmans and good luck in growing into the future. So today, we kind of going to touch on lots of components. This is not a lesson on the market, although Keith is touching on a bit of the detail there. But it's more around what do we see happening in the sector? Our view of the timing, and I think Cresco's view is slightly different to Keith's view on the timing, but that's the whole point of this. We have opinions and we all want to develop it together. Alex is going to touch on, so we have the market developing, but then we've got this whole bilateral market also. How does it fit in? Change in law, most people's favorite topic. Me as an accountant and lawyers, I think, are so excited about that clause because I think there's going to be lots of opportunity there. And at the end, and then Andy Tant is doing a brief 2-minute explanation on how to do decarbonisation modelling. So I hope you all brought your Excel tools, but a little bit further than the type of work we've done later. And that's sort of just an intro to the other type of work Cresco is currently doing outside of the market code. And then we have 4 traders, I think, in my view, quite different offerings, quite different opportunities, and they'll bring their view of the market through a panel discussion coming later. So this is recorded. There will be a recording sent out later. The slides will be available, so you don't have to take pictures and so you have full access to that. And the idea is we'll do our presentations, and then we'll take 1 or 2 questions in each one. We'd prefer if you can keep your questions down to short ones, although also happy to take very short comments too. Thank you very much. So Cresco's view of the world, and apologies, I did do some of these slides last week, is we now have a proven bilateral market. We're seeing BESS, albeit at a small scale. And in fact, our view is that future projects that are going to get to financial close will have BESS involved in some way, 2 to 4 hours of BESS, at least in the short term. We have now market liberalization coming. We have our first import-export license. So the world has moved. And if you could graph South Africa's legislative changes, it would be a hockey stick, which we are very excited about. But the key themes that we're looking at for the year, and unfortunately I'll touch on them again in another slide, is Eskom retail tariff plan. There was a NERSA hearing early in the week. MYPD6, I don't think anyone guessed 12.7%. In fact, we're doing a whole lot of analysis on that, and I'm glad we didn't present it because we would have had a fair bit of egg on our face because we definitely had higher views. The multi-market model, the primary reason for our being here. And then I guess to a certain extent, load shedding, excess energy, and then what's happening to gas. And unfortunately, one of the outputs from our presentation last week, and if you send us an email, we'll send it to you, is that the story around gas, unfortunately, is not as solid as we had hoped. There's lots of good things happening, but in our view, 2028 for large-scale gas generation and maybe even gas for the industrial users group is a bit of a stretch. And I think that brings a bit of a negative to the energy market going forward because of the need for gas as a dispatchable technology. So you've all seen our projections over time. We do have a new version coming out, but I think that but our view today is, I think, quite similar to what we had in November next year. Slower large-scale renewables rollout due to grid constraints, larger BESS implementations just because of the value of BESS is there. Coal decommissioning, either with an Eskom plan or because Eskom has to decommission because the old power stations aren't working as efficiently. Perhaps not, definitely not the JET program, but we think it'll be quicker than the Eskom program. And then large-scale gas, unfortunately, still only coming in 2030. So some good news stories, but unfortunately still some bad news stories from a load shedding or maybe a limitation between supply and demand constraint. I was recently on an interview and they said, you predicted rolling blackouts and you need to be very careful around the terminology that is out there. I don't think we ever said that. NYPD. So we have an article coming out as Cresco. Shirley Savoldi wrote it with one of our analysts. I won't quote her initial version of the article. It was a much stronger than the official version that came out. But I think we are concerned around some of NERSA's views, some of their calculations, and to a certain extent, our view, perhaps very simplistically, is that 12.7% was a massaged Excel number rather than a thought-provoked engagement. And there's a few things that are a little bit concerning and surprising. We all look forward to the record of decision, but I understand that's probably only open out April, May, later in the year. So before we can do detailed analysis, I think that we're waiting for that document to see what was substantiated by NERSA. And then where are we on sort of the market code as Cresco sees it? So we've had the workshops, we had public comments. Cresco provided a number of public comments on behalf of clients. I know other clients did too. I know we're engaging with Keith and the market operator on detailed feedback on the public comments. We're looking forward to code version 2, and Keith can correct us on the dates there. You know, in our view, cool. Would you come up and tell a joke in the meantime? Oh, why not? Is that okay? Thank you. So I'm going to start with number 2, just to get back on track. Sorry, if you could, I moved the slide, apologies. So, you know, sort of, I understand that Keith is now taking the market comments, moving forward. There'll be additional workshops, and we all look forward to version 2 of the code. I think Cresco's view is we are probably going to be slightly delayed. We think balancing market will be there first. We think there'll be a testing with a couple of the larger players in that. And then our view is that the full market, and when we say the full market, all the components of the market, as in doing, will happen slightly later. And I think the reason for that is not because of the great work that Keith and his team are doing, is because there's a lot of other stuff out there that we just think takes so much longer than needs to happen. NERSA's involvement, the retail tariff plan, and then to a certain extent, the banking environment in South Africa also needs to catch up, because we're conscious that the financial energy market is very underdeveloped relative to what the energy market is. And in our view, for a market to be efficient and at least working, both of those need to move together. And so in our view, unfortunately, there's a lot of stuff that is out there that is perhaps not running at the same pace as the market code, and that could cause some of delays going forward. Now, this is my marketing slide, so I apologize in advance. Many of you have already received a proposal, so once again. But really the key things that we are doing at the moment for most clients is The Eskom retail tariff plan, where is it going? What will NERSA approve? We understand it might be delayed until 2026, although the hearing yesterday, I think, will give some input into that. And unfortunately, the impact is quite material on the value of renewables for large buyers. Wheeling savings reductions are significant. On-site are also there, but it very much talks to on-site being the most value for money available out there. It also talks to the value from BESS in terms of opportunities. The other bit is the NYPD applications. So we've remodeled from first principles, base costs, RAB, and we're trying to come up with 3 views. We now have a 4th view, which is how does Eskom make up the fact that they only got 12.7%, and how does that get reworked in? And that there. The other one is the value of carbon. At the moment, we haven't really ascribed value to carbon significantly, at least in any of the financial models. And what is the impact of carbon tax? What is the impact of the environmental levy or the carbon component of the tariffs? RECs, ZRECs, IRECs. I mean, the fact that the REAP projects are now selling RECs in the market. So we had a constrained market beginning of last year. Cresco actually bought a few RECs, and now we have too many RECs. And I guess what is the value of that? And then the last bit is the work we're doing around the multi-market model, which is the purpose of today. And as you're aware, we've done quite a bit of bottom-up analysis. So our numbers at least are hopefully some sense behind them. We've modeled from first principles there. I think the bit that we don't have yet, and we keep on asking Keith and team nicely, but we haven't got it yet, is what Eskom's min-gen profiles would be and what the cost of power per power station is. So we can really try to understand marginal cost of dispatch. At the moment, we have some shortfalls in our modeling there, but we're hoping to get that data over time. Eskom has been really good at responding to PPA requests for specific data. And so I think the transparency and the amount of information we have now is chalk and cheese from what we had a year ago. Because previously, the view of Eskom's price increases was 5 of our clients who had a left thumb, and we called it a consensus view. Whereas now, we may not perfect, but we at least have some Excel to support the analysis. And then the market. And I know Keith will touch on this in a lot more detail. But as I mentioned, the real bit that we see is the opportunity is on the balancing market or perhaps the risk. A lot of the bilateral deals that were closed last year are very silent on balancing implications and forecasting. Forecasting is more on a best endeavors basis than any penalties attached. What is the true value of ancillary services? So in the current NYPD, there's a big number for ancillary services. We believe it is understated on a rand per kilowatt hour basis. Just simplistically, we're trying to unpack that. And that all talks to the best value emergency reserves. And then once again, I think everything in system operator, market operator, it is sort of sitting within Keith's world, and he's pushing ahead and doing a great job. The bit in gray is outside of the code. It's touched on slightly in the code, but it's definitely not in their control. And our concern is that we perhaps not running at the same level of engagement there. We have been engaging with the banks, and they are aware of that. But I guess there's capacity constraints there too. They're trying to close deals, do aggregated deals, get new deal flow. And this market is sort of something that they're aware of, but perhaps not fully focused on. And even if we achieve the midpoint between Cresco's view and Keith's view of the market there, in my view, the banks need to start thinking today. And maybe not just the banks, but the equity investors as well as the insurers, because we don't have enough money in the system to build the cool toys that we need on the projections to actually make up the shortfall of gaps. We need more friends. I think there's lots of friends calling, but at the moment, they haven't really been able to fit within the current South African situation. And then the real value of BESS, and apologies, I've used this slide too many times, but I'll go through it again because I think it gives a real input into. So this is an extract from the system operator, courtesy of the Chris Yelland WhatsApp group, so thank you, from September 2023, and this is net of coal generation. So these are other technologies. And you can see the wind coming online. I think most of this is REAP projects. We didn't really have any private sector deals get to COD by this stage. Yeah, you have the imported hydro, which funny enough doesn't come through every part of the day, but you can see it increases as the demand in Zambia, Zimbabwe, Botswana reduces and those electrons flow south. And then the red bit here is called natural gas pipeline, but it's the diesel generators, Avon, Didiso, Ankelich, and Rikwa, running, maybe not full tilt, this was a load shedding day, but pretty consistently throughout the day. And this is just with 7,000 megawatts of renewables. If you believe Cresco's number of 20 to 25 in 2030, you can imagine that we need 3 to 4 times the amount of red to really balance the grid to make it viable. And at the moment, that's not going to come from BESS. You're not going to build a lot of new diesel. And unfortunately, it's not coming from gas in the short to medium term. So for me, this is a real eye-opener around the type of technologies you need to balance the grid, and that talks to the ancillary services and other types of support. So not quite a market code, but hopefully introducing Keith and the market code in a bit more detail. We will take 1 or 2 questions after each speaker. So any questions for me? Cool, nice and easy, thank you. Keith, can have you up. Sorry, James. Just going to cue the next presentation. Let you use the clicker.
Yeah, I think we can start while that's busy loading up.
Yeah.
So afternoon, everyone. So it's Keith Bowen from the market operator. I suppose most of you might have logged into our market code workshops during the course of last year. Got rid of the beard to a large extent, so hopefully it still looks vaguely familiar. To a large extent, the work that we've did under those market code workshops was around trying to connect with stakeholders around what we had in terms of the plans for the market. What I'm going to do today is try and not spend too much time on reiterating what you've already heard in those workshops, but just to kind of highlight, as Robert's talked about, the idea is that we're focusing on a component of the broader market. And as I said at the time, and I keep repeating it, is that to a large extent, we already have a market. We have competition for the supply of electricity to a certain group of customers, not everybody. It's very limited at the moment, but the market is here. And an important aspect of that is that, and I've used the analogy many times over, we're a little bit in the Wild West, where we have deals going on, things are happening, but the system operator doesn't know what's going on. It may be in real time, it can see the electrons flowing, but there's no day-ahead commitment. There's no information about what we can expect on the day. So we don't have the sheriff in town. The Wild West is going, everyone's running up and down the street, firing the shots off, and there's a little bit of chaos. And what we're proposing as part of the market process is that we have a little bit of a sheriff, just trying to manage, so people can still do the deals, but there's some information flows that the system operator is able to see what's going to happen tomorrow, plan around it, and then there's some obligation that people could commit, and then they actually execute on what they had promised the day before. Because the grid, I know some of you may have read The Economist did an amazing article or a series probably about a year ago, talking about how the electricity grid is the most complicated machine ever developed, by humans, because it's got so many moving parts. It's carrying energy from place to place. It's maintaining voltage. It's maintaining that energy and power flows across this grid. And if we're not careful, if we're not managing that resource effectively, if each of us is just doing our own thing, then it can lead to a collapse and it can be really problematic. So the whole principle of why electricity markets are a little bit different from other markets is to be able to sustain that this grid supplies for everybody. So I know not everybody loves the idea of centralized markets, but it is crucial in any electricity sector around the world that you do have this coordinated look and view of how markets operate. So I do have some slides to talk about the process, but I realize, we don't have all the time in the world today, so it's not going to be another classroom session to talk about what we plan. But just again, to reiterate that the idea is that the market is there. We have the physical bilaterals. We have trading taking place. What we're introducing is this centralized platforms, and they're mainly physical. As Robert said, we're focusing on day-ahead energy, intraday, and balancing, and then obviously the reserves. And Robert, also thanks for pointing that out, this idea that the ancillary services that are costed and passed on through use of system charges at the moment are a mere fraction of the true cost of what those ancillary services are worth and what they should be recovered at. It's one of those tragedies of a monopoly, and I'm going to get beaten up back at the office for this, is that we often don't look at the true value of anything when we're trying to cost what something is actually worth. And ancillary services has been the victim of that for the last 25 years. That we don't look at what is the value of a reserve, instantaneous, regulating, 10-minute, all these different reserve categories, and we just cost it at some sort of marginal little amount of money. And therefore, we're not actually seeing that the system operator doesn't get enough of the reserves that it needs. It needs more. And by putting in the markets in place, the system operator can provide that signal that we want more of these reserves, and then more people can provide them. More generators, demand response, all those kind of facilities that are out there struggling to find a buyer for those services. Now the market actually provides that mechanism for them to be able to do that. So it's quite an important aspect, is that these day-ahead reserves would become a cornerstone of the market and being able to value those reserves adequately. The central purchasing agency is generally, everybody always gets a little bit nervous. Even the central purchasing agency gets a little bit nervous about its role in the future, because it's there to try and bridge between the current environment and a future fully competitive market. And the idea is, yes, we will be applying to NERSA for a revised trading license for the entity. So it will be trading, but it's trading in a very limited way. It's trading to recover money, that it's spending money under the PPAs with existing Section 34 IPPs, and it has to recover for that. It's got to sell energy into the market, get what the market pays for it, and then deal with the difference, which is what we call the legacy charge. And one of the big things out of the retail tariff plan that was discussed yesterday is now a consideration that at a retail level, and also a future in the wholesale level, we have a separate accounting for this legacy charge. It's a huge breakthrough, and it kind of really indicates that we can kind of move that component out, and the system operator, the central purchasing agency, can recover it while we're moving into the market environment. So again, the idea here is that we expect supply and demand, and we would hope that eventually we would have price responsive demand as well. So you've got consumers who can indicate their value of electricity. At the moment, obviously, we have a regulated tariff, and it's all about what, between the monopoly and the regulator, we kind of agree, and probably most times not agree, on what the cost of electricity is, but no one's really factoring in the value of that electricity. And the whole idea of that market is that you start getting that information flowing, and you coordinating between those two entities. Constraint generation is also something that's quite a huge discussion point at the moment. And I do strongly believe that the market actually helps us in terms of isolating and identifying the cost of that curtailment and what constraint generation means. Quite importantly is that, you know, there are different ways around the world that constraint generation is managed. And to a large extent in Europe and in the United States, they pass the cost on to consumers through regional pricing by saying that, you know, if there's a constraint, you're going to have price differentiation between a constrained area and a relatively unconstrained area. And that price is then dealt with by the generators and the consumers in those areas. To my mind, I think it's a little bit of a cop-out by the network operator, because the network operator is the entity that's not going to say they caused the constraint, but they are the ones who can actually best alleviate the constraint. And by passing the cost on to everybody else to deal with, I think it kind of gets us into some trouble, because then we never actually deal with the constraint in a proper way. But that is something that we've built into the code, that it becomes not price areas. We're not going to go through price areas or locational marginal pricing, but that we spread the cost amongst all consumers. But the idea is that the regulator then manages and says, well, the network operator can't just be passing on these costs. You've actually got to build something to avoid these costs in the future. Yeah, as I said, I'm not going to go into it, but the idea is that we have an intraday to be able to allow for producers and consumers to adjust their positions. One of the debates that always comes up is that if you're a physical bilateral participant, you're a balanced responsible party, can you adjust your position? And the reality is we've kind of come down on the no, you can't. You can become a market participant, and therefore as a market participant, you can adjust your position. But the idea is that if you are not a market participant, adjusting positions in real time or just before real time creates problems on the market, because now you've got additional energy or shortages of energy and there's no accounting for it. Whereas as a market participant, someone who has a physical bilateral and they want to adjust their position, they can either buy the additional energy or sell it back to the market as a market participant. So there are options for everyone, but the idea is that you have to be a market participant to be in the intraday as well. And I'm not going to go into the balancing. I think quite importantly, though, just to kind of highlight that from a balancing perspective, we can design a balancing system that is highly punitive. We can go and look, and it's been done in some jurisdictions where the marginal price of the entity that's providing the service is paid for by those that cause the service, cause the imbalance. And that can, it sets, like we do on the day ahead, you have marginal pricing for balancing. The problem is that is counterproductive if everybody is building their own capacity to back themselves up. So if you've got wind farms, you've got a portfolio and you have that risk, and so you go and build your own batteries or your own gas plant to be able to back yourself up so that you can never be exposed to balancing, that's deeply inefficient if you can pool those resources and the system operator is managing the balancing on behalf of everybody. So it is an important aspect of the design, is to say, how are we incentivizing balancing, but not making it so incredibly punitive that people are backing themselves up. So that's also quite an important thing as part of the design as we're going into the market phase. One of the things that we have talked about quite a lot is the vesting contracts, and I know Alex is talking a little bit about that later. The vesting contracts are really meant to be the bridge between a regulated tariff, which is what we have now, and a competitive price, dealing with market power, both Eskom generation, Eskom distribution, have that market power and trying to deal with that during the transition. It is a key component in the next year to be able to finalize on what those vesting contracts look like, and also make sure that they go through a public participation process. NERSA would have to sign off on what the vesting contracts look like, and they have a key spin-off and impact on how the market will function if we've designed those contracts well. If we've designed them badly, then there also has huge negative impacts in terms of how the market works. And I'm going to talk a little bit about that in the future coming up. One of the things around the wholesale tariff, so the retail tariff plan helped with kind of setting the tone of what we're trying to do for the wholesale tariff, is unbundle these different charges. So it's the generation charge, the capacity charge, the legacy charge, those different components, which all market participants, even if you're buying your energy in a competitive environment, there's still an expectation that there's an obligation to pay for those things because the system requires them in order to operate. The capacity charge, we hope, will be replaced by a capacity remuneration mechanism, and that then becomes a market in and of itself to trade for capacity products into the future. But the vesting contracts cover capacity for now for the legacy plant, including the Eskom generators, and we build that into a generation capacity charge downstream. It's very clear, and this will be part of the process when we go talk about the vesting contracts, is at what level that capacity charge downstream is relative to what the capacity charge is to the generators, because I don't see them necessarily tying up. The signal to the consumer is quite different from the actual cost or the fixed cost that generation would want to recover. And the NTCSA sits in the middle, having to deal with the risk. So that is something that we will be discussing a lot as we get into the application of the vesting contract. And again, I've tried to illustrate the issue here. I'm not sure if you're seeing a funny line across my slides. I don't know how I did that. But the idea here is that I took the decision. So this is the decision for FY27, what the regulator put out last week, to look at what generation would have to recover and making an assumption that we split it 50-50 between capacity and energy. What would that capacity rate be per megawatt per hour? What would the energy rate be to be able to recover for that? At the same time, we also have an approved IPP revenue and splitting that between the capacity for the dispatchable IPPs and then the energy for the rest. And then looking at what would that mean for a downstream recovery. And as I indicated, generation would like to get at least 50%, and I'm pretty sure they want 70 or 80% of their costs recovered through a fixed charge. But there's just no way we're going to be able to pass that on to customers, even at the current rate. So we would have seen that the retail tariff plan is starting at 20% of what we had asked for. And even what we had asked for was 50% of what we think this cost is going to be. So it's going to take us a while to get the capacity to the level we think it needs to be, but it's never going to be that. It's just too high. So it is one of those things where as we break these into the different components, being able to balance between what's a cost and what's a signal to the consumers and making sure we were accounting for those correctly. So this is, again, just an idea from my side, looking at how these vesting contracts might work and how the wholesale tariff might look into the future. We also tried to just differentiate between the transition period as defined in the ERA. Okay, it's not defined, but it's identified in the ERA, talks about the transition to the independence of the TSO. So the transmission system operator is meant to be in place as a fully independent entity from Eskom by 5 years from the date. So it was 1st of January, so by the 31st of December, 2029. But we also envisage that there's another transition, and this is more about what I call the market transition, that we've kind of identified it as a 5-year period. It might actually end up being more, depending on the market power that resides within Eskom generation to deal with the vesting contracts. So it's just important that there's different kind of transition periods that are all happening at the same time. But from our perspective, from the market, we are still aiming 1st of April. And I know Robert said that, you know, they don't agree with me, but one of us is going to be wrong on the 1st of April, 2026. But the idea is we want that market there. Even if it's the bare bones, you know, if I'm going back to English Civil War kind of things, a bare bones parliament, it's a bare bones market in place. The idea that it would be there to set the signals and provide for all the basic requirements. And we might have to do building blocks to that during the course of the year, but we're still aiming for that 1st of April. And then we have the market transition that kicks off where the vesting contracts will apply. And that's quite an important aspect to kind of how we then transitioning to the full competitive market. And we hope, you know, with a lot of, you know, as they say, what's it? Hope is not a strategy, but we can kind of hope that things will happen to be able to mean that generation's role in the market is a smaller one. And so we are able to then kind of have a fully competitive market without the vesting contracts. So this is our roadmap. And again, it's our plan for this coming 12 months. And there's a lot of components. Most of them are minimum requirements. We've trying to set up this idea that what has to be in place to make the market viable on the 1st of April. And it's not necessarily including having the financial bilaterals and all that kind of stuff in place. Those are nice to have. We believe you can still roll out the market without those things, but there are some things that are minimum. The first up here is our market operator license. So we have now kind of finalized our license application. We've got approval from the NTCSA board to apply. We're just waiting a couple of weeks to give NERSA some time to comment on what we've given them as a draft, and then we will apply for the license. It might take another 2-3 months. So we've sort of said that from a NERSA perspective, it might only be June for them to actually issue it to us. But then at the same time in that period, we will then submit our code, the market code. Hopefully we'll have finalized it by the end of March and gone through governance to submit it to NERSA and given them a few months as well to approve the code or to adopt the code. So that's also sort of around that time period. Some of the more complicated things, for example, are the vesting contracts and the wholesale tariff, or the regulations around the wholesale tariff. Those may take longer. Those are definitely things where there's a lot of stuff to deal with over the next few months, but at least, you know, that can start working in parallel while we're finalizing on the code. One of our biggest things to aim for is also to start with training. by March, that we've kind of, sorry, by May. We're sort of looking at developing the sort of training program and having regular monthly, if not fortnightly, kind of interventions and sessions for people to attend in order to get people geared up. And the simulation would be part of that. We want to have a simulation where the markets, people can trade and see what those different things would look like. So that's quite a massive undertaking that we're hoping to try and do earlier in the year. Our big thing then after the code is with NERSA is the upgrade of our systems. I'm sure I've said this before, we do have existing systems. We've got internal systems that we use. The generators are bidding every day. We are setting prices every day. We're doing the settlements between distribution, generation, the NTCSA, all that stuff's there. It's just not what I would say is robust. And it's not there to manage external parties. We've launched the wholesale market platform. We're still sort of adding users to it. And that platform originally was designed for us to communicate with the Section 34 IPP. So it's all around metering and forecasting. And we're now adding modules to that to allow for bidding settlements, all those components which would actually go through that platform. So a lot of the building blocks are there. It's about making them ready for a full market environment. One of the things that Rob did point out is also interfacing with banking. Making sure that, when trading takes place and is on a daily basis, making sure that those mechanisms are in place to be able to read, the money flows and check that the money's there when people are trading. So that's quite a huge component that we have not even started touching on, and that might delay us to some extent. Then, as we said, the idea that there's bilateral hedging, we would like to put something in place for that and then work on a capacity market and then finalizing the agreement. So there are things that have to happen during the year. We've got a plan for each of them. Our first focus is really going to be around these, at least these three, but these two are going to be critical before we can launch. So that's pretty much what we're planning for the year. And I know there's lots of people like saying that there's just no way. But the idea is if you put a peg in the ground, at least people can focus and work on it. If we shift it out 2-3 years, nothing's going to happen until 2-3 years. So it's kind of quite important from our perspective to start now and get that ready. Yep, that's it from our side, unless there are any questions. Yeah, sorry. Okay.
I'm going to take the first question because we're here. So balancing.
Yeah.
So we did a webinar about the inaccuracy of balancing. You and I had a chat afterwards around some of the variations were pretty large. But in my view, you could start balancing today.
Yeah.
Or what is missing for you to have a balancing market today?
The most important, if you think about the scheduling and dispatch rules, which are a component of the grid code, actually calls for a balancing mechanism. The rules are there. We're supposed to have balancing. But the biggest thing from our side has always been, what is the reference price against which you're pricing balancing? So you could do balancing and just say, right, the WEPS rate is balancing. Absolutely, you can do that. Because we're getting in the forecasts for most of the generators, even those that are not Section 34, they give us forecasts because they have to. It's built into the grid code. So we get those forecasts. We get them submitted every day. We meter the actuals. So theoretically, we can start doing balancing tomorrow. But the idea is the pricing is an issue. You want the pricing to reflect what is the status on the system when the imbalance takes place. So yeah, it is definitely an issue about putting those things in place to make balancing work. But I mean, principally, balancing is about the forecast, the actual, and the price. And two of those we've got.
Any questions? Any questions? There is a roving mic. Keith?
Yeah, off the hook.
Got off lightly.
Yeah. Yeah.
I'm surprised. Are you sure? I have one more question.
Okay.
Then. So you back to balancing. So could NERSA not approve a balancing tariff schedule by April 26? We have to be fast tracked. That would set those rules of engagement, or call it marginal costs, 50% of marginal costs. That could happen and set it in place.
Yeah, we could. So, I mean, Precious will know. We've been doing some work with Africa Green Co, and we kind of trying to make it a generic contract that the system between the system operator and an independent power producer that's not a Section 34, we can put in a balancing agreement. So we've come up with a draft and we've got approval from the NTCSA. We've got a few outstanding hurdles to kind of deal with. But the principle of that is that a generator provides the forecast. If they deviate from the forecast, if they do more than they were supposed to, we will buy it under the standard offer tariff. So we have a tariff under the standard offer for that. If they do less, they would have to pay for it under the WEPS rate. So we're using the standard offer and the WEPS because those are existing tariff structures. What we then commit to is that the pass-through to the customer is the forecast. So that instead of the forecast being what's used, the metered values being used for the wheeling credit, it's the forecast that's used for the credit. And any deviation from the forecast is then between the generator and the system operator. The big thing that was then included in that contract was curtailment. If the system operator asks the generator to back off because of constraints, we would pass the credit as if they had generated it. And that component would then go into the ancillary service that we're trying to approve with NERSA. So yeah, it's kind of a cornerstone that could be the future balancing market. It's this balancing agreement that's there as a voluntary arrangement between an IPP and the NTCSA.
One more question. Sorry. There's a question from someone else.
Yeah, just a quick question on the
Sorry, could you just stand up and introduce yourself? Sorry,
Okay.
just I was looking for the, thank you, sorry.
So it's Devin from Old Mutual. Just a quick question on the forecasting for IPPs. So we understand that, you know, if you are within 5%, you're paying the SMP. If you're above 5%, you're paying a slightly higher penalty. But just given the nature of renewable energy, the source of renewable energy and the variability, is there any sort of concession for IPPs, just given the variability in the energy source?
Yeah, that was actually one of the comments from that we received. The theory from my side is that no, it wouldn't be advisable because then you're targeting rules for specific types of technologies. That, you know, it needs to be a consistent set of rules for everyone. And if that generator, again, it's all about how you design the tariff. So if you can't improve your forecast, then, you know, there has to be some incentive to do that, to try as much as possible. And that's why portfolios generally work better, because then you can at least balance across multiple portfolios. But the moment we start going down, it becomes a slippery slope to put specific rules in for specific generation types. I think it could be problematic. And I get that wind is a lot more difficult to forecast than PV or any other. But it's the same with a coal power station having to commit for tomorrow when, you know, they could be fully on or fully off, and they have to accept that that's the risk that they take. I think these are quite important things to understand, that the impact of that imbalance is relatively high unless you are managing it through a portfolio.
Yeah, hi, sorry, it's Simon Hall from the Solar Group. Thanks a lot, Keith. Great presentation. I just had a question. Has anybody done any modeling on if that market was to open April next year, the actual price of that power in that market? Is one of the things we've studied is that price, obviously, given the scarcity of energy at the moment, is exponentially high. So the question also, if are the caps, potentially caps, anticipated to then stage the market, for example, with the price, with a big price increase shock?
Yeah, so I know Cresco has been doing some work, and I'm sure that will probably come up, but trying to anticipate what the prices would look like is also really heavily influenced by what those vesting contracts would look like. How much of generation's cost is recovered through fixed costs outside the market, and how much is going to be in the market would decide that. But absolutely, in a energy constrained environment, the price would be expected to be higher, and we can't afford that the prices go to diesel rates on a regular basis. So the idea then is that, yes, we introduce a cap. At the moment in the code, we've set a cap at whatever our wholesale tariff peak rates would be. So at the moment internally, we have a wholesale tariff, the average of the peak winter and peak summer, it's a R2.40 a kilowatt hour. That then sets a cap. That might be higher or lower depending on how we design the wholesale tariff into the future. But that cap is quite an important aspect, at least for the transition. That you have the cap. I'm not a fan of caps. I think caps lead to some dysfunctional behavior and they're not providing the signals, but at least during the transition, we protect participants so that in the long run, we can remove them. But yeah, in a constrained environment, it does make a lot of sense to do that.
No more questions. I have one last one, sorry. Apologies. The value of carbon. So you're an energy market, we have a financial market, JSE's got a carbon market starting. The linkages, because I know the Indian market is a premium for green through the market code, and I'm conscious that we don't want to derail April 26, we'd love April 26, but has that come into any of the considerations to date?
Not really. Again, we're trying to not differentiate between different sources. The idea then is that if there's a carbon tax, which there is, the carbon tax would impact on the price that a coal plant would have to bid in at. So they will have to internalize that cost. Obviously, and we've had discussions, I think the World Bank raised this, and it is an issue, is that every time they internalize that cost and they are the marginal generator, that differential is essentially becomes a tax on everybody else because the market price is now higher by that amount. And it's because you have distributive issues in terms of everyone's paying for the tax for one party is subject to, but everybody gets, the consumers have to pay and all the producers get the benefit. So there definitely is an issue there. But in reality, that tax helps to internalize that cost that we see on the system. We haven't done any work on it, but there's always the possibility that improving the certificates, the renewable certificates trading mechanism, then becomes a premium because then you can sell that product as a separate thing from energy. And specifically, as we go into a balancing environment where, particularly if you're an off-taker for PPAs that are renewable, and now they're not producing for whatever reason, and so the balancing is meeting your requirements, you would have to buy those green certificates because as the market, we're not identifying what energy is green or not green when it comes to balancing. We're just giving you an energy price. And so that shortfall would have to come through a renewable trading mechanism. Okay, cool.
Okay. So hi everyone. To those of you that I haven't met, I'm Alex Felekis, and I'm a partner in the Bowmans Projects Infrastructure and Energy team, led by Mr. Alan Luther, who did the introduction. We're a group of 32 lawyers helping our clients on energy infrastructure projects across the continent. So we've been following the market code since it was issued. Alessandra Pardini and I were two of the three lawyers that were invited to actually engage with Keith and his team in the more closed market code engagement sessions. So what we're going to do today in the next few minutes is just deep dive into the legal considerations in relation to the market code, but with an emphasis or a focus on how it actually impacts generators and consumers of energy from a private PPA perspective. So it's helpful that Keith has confirmed, and you saw in Cresco's diagram and in Keith's diagram, that private PPA arrangements would still be permissible. But I'm here to tell you today, and I think this has to be the key takeaway from everyone sitting here, is that it isn't business as usual. And there'll be changes to the framework in which these agreements currently operate, or on the basis that they were closed, that have to be considered in terms of either amendments that may be required or how you negotiate these arrangements going forward. So if we focus first on the generation side of things, so SALA, IPP, whichever term we want to use, and we look at from a contractual structure, the QOSA in itself doesn't change much. So the generator still enters into QOSA. As you've seen, Keith did put on the screen that the fact that your use of system charges potentially increase. And as a generator, you're also liable for network charges and losses. Your PPA is still enforceable, but there's certain things that may change certain rights and obligations that you have under that PPA. And the first one is what Keith touched on and Rob asked quite a few questions on, and that's the fact that as a generator of energy, whether or not you actually feed or supply that energy into the market, you become a balancing responsible party, which means you provide a forecast a day ahead and you're held to that forecast. If you aren't a market participant, you can't actually reschedule that forecast in the intraday market, which potentially exposes you to more imbalance risk than a market participant. And I think that potentially, depending obviously how generators structure themselves, is something that's going to be a key consideration of whether you are a market participant or not. Very importantly, in the way that the customer receives energy from the IPP is going to change. It's very unlikely that we'll still have traditional wheeling when we really do have a competitive multi-market model. What we'll have is an open access structure to use the network. So in the same way that you have now, the IPP enters into the QOSA and the IPP plays use of system charges, the customer will effectively do the same. So the customer will have its own use of system agreement and it will pay that charge separately. A very important point that I think, just can't be underestimated is the fact that the way that what the customer actually pays for is what the IPP's scheduled generation was. So if the IPP actually generates less, the customer still pays what was forecast, and that imbalance or that up or under is then resolved through the balancing market. It's unlikely that monthly reconciliation will still apply. The rest of the markets will trade on an hourly basis. There'll be new prices on an hourly basis. So effectively, unlikely that Eskom distribution, and this is just an opinion, would effectively want to take the risk of the rest of the market is hourly, but they still reconcile monthly. And I may be wrong about this. So importantly, we do think that the market is evolving, and I think that is signified by Eskom's congestion curtailment application and NERSA's recommendation for approval at late last year, that effectively the network operator now would compensate the IPP or the customer to the extent that there is a curtailment, and the reason for that curtailment is grid constraints. I think that's a good indication that going forward, taking into account also the lost opportunity cost formulation that Keith touched on, that we're going to get to a place where if you're an IPP, whether you're a market participant or just supplying under private bilaterals, effectively you would have the network operator either providing the customer with the credit, if that's still the mechanism that's used, or compensating the IPP directly. And I think importantly, and I know that it might seem obvious, but I think that it's going to be one of the key things that determine who participates in the market or not, is the IPP keeps the environmental attributes. Those are not transferred to the market and then transferred onto the ultimate customers. And that in itself makes me think that for heavy electricity users, and taking into account their carbon reduction plans and targets, effectively, we are still going to be looking at long-term private PPA arrangements. They effectively might not continue to be physical supply, would effectively convert to financial or contracts for difference in the near term. Okay. From a customer perspective, a lot of the principles I've already covered, but in terms of the electricity supply agreement, that changes. So that electricity supply agreement will now be split into two agreements. You'll have an agreement that deals with the supply of electricity from Eskom distribution, and you'll have a separate agreement with the network operator for use of the network, and the customer will pay a use of system charge for that, as well as network charges, subsidies, ancillary service charges, and very important, as Keith touched on, and we've all been talking about it since it was introduced, the legacy charge. I think it is obviously helpful that these charges are regulated and obviously would be applied, socialized across all customers and applied in a certain manner. So the PPA is still enforceable, but I think these are the key points to note if you're a customer. You would want to potentially bid into the market as a trading facility, which effectively means you're bidding in more than one either point of generation or point of consumption in order to mitigate your own balancing. And what that means is in the PPAs, you effectively would be asking, you would want to impose forecasting obligations on your IPPs and have a mechanism that to the extent that there is an imbalance settlement, you're able to claw back from the party that was incurred. Okay. So, so obviously now, having just taken you through that, it's obvious that changes may be required to existing agreements. And that's where change in law and relief for change in law comes in. We can't only look at the PPA, we have to look at the broader wheeling framework, which is the QOSA and the amendment to the ESA as well. Importantly, under the ESA with the customer and the QOSA with the IPP, there isn't a robust change in law regime. So most of you sitting in the room have negotiated your change in law clause over various months. You feel comfortable that when the market code is effectively promulgated and issued, it falls within change in law and you'll know exactly what to do under your clause. We don't have that under the ESA and the QOSA. But what we do have is that the party has to exercise their rights and comply with their obligations in accordance with all laws, ERA, the grid code, and the grid rules. And what we foresee there is that Eskom distribution will effectively amend these agreements, relying on that. The parties will sit, and actually that's on the next slide. Let me show you that structure. Okay, you're not going to see the diagram, but I'll talk you through it. We're there, hey? No. Yeah. So you'll have Eskom distribution effectively saying, based on this and to be in compliance with all law, we need to renegotiate here. The parties will sit down and try and renegotiate. And effectively, if the parties don't agree under your existing agreements, you've got a much longer dispute resolution process than you do under your PPA. You've got that effectively it goes to internal negotiation, then mediation, and then arbitration. And importantly, you can't terminate the QOSA or the ESA for change in law. I don't think that's problematic because I don't think that the market code becoming a rule of NERSA would necessitate a termination, but it obviously incentivizes parties to agree on those two agreements. All right, so from a PPA perspective, and this is obviously not from anyone's deal and speaking just very broadly, in terms of change in law as a definition, implementation, promulgation of the market code is change in law. Even if you have that carve out in your change in law clause about if the bill was, promulgated in the form that it was in on the signature date, the market code is not the ERA amendment bill. And it added a lot more detail to what that bill was actually contemplating. And then whether you can apply for change in law in a very quick and efficient manner depends on how many materiality thresholds you manage to negotiate if you were the buyer. So the affected party, in my view, it will be the IPP or the lenders through the IPP that are asking for this. You'll have to prove that the event satisfies the change in law definition. That one's pretty easy. That your economic position has been affected. That might not be as easy. And then potentially satisfying a materiality threshold. The party obviously puts forward their proposal in terms of how the tariff has to be adjusted, how the agreement has to be amended, and the counterparty decides whether they accept that or not. And if they don't, the parties usually, when it's change in law, because you want it to be resolved quickly, go to expert determination. Importantly, you do, in some PPAs, have a right to terminate for change in law. And that's obviously, some of you may know this, if your the relief that has been provided by the buyer under change in law has resulted in breaching an agreed threshold that effectively just erodes the full commercial intent of that. And as much as that might be a principle that applies, we think it's going to be a very difficult hurdle to prove when we're talking about the changes that are contemplated by the market code. What we think in our minds, it's more amending agreements so they fit within the new framework. Okay. I mean, I think I'm gonna hop on this now, but I think that the key takeaway for today, and I think, you know, Rob mentioned it, is in the PPAs that we negotiated in previous years or reached financial close on, as much as error might have been there, the detail in the market code was not there. So it is something that requires detailed consideration in terms of how things have to be amended and how they have to change. And obviously detailed consideration in the deals that you're doing now and that you will do in the future. Okay, so going to the market code, and I just wanted to highlight the force majeure clause in the actual market code, because I think it's important, and a lot of you know that we negotiate force majeure for months on some deals. So very happy with the definition. I think it's a very standard definition. What's really important for the private sector is the fact that you have a balancing responsibility obligation. And we've just heard that if you're an IPP, if you're a generator, and you choose not to be a market participant, you can't restate your position in the intraday market. You carry more balancing risk. That effectively, what if you forecasted the day ahead, this is what you generate, and a force majeure event occurred, and that's why you underdelivered? This clause is so important because this clause effectively provides you with relief. So this is in the market code, but Keith and I debate these things often on 5 minutes notice. He fits me in. Is effectively, you know, this would actually need to be reflected in the balancing agreement as well as the participation agreement for the market. Another point that I just wanted to raise is, as you all know, if you look at electricity markets, you know, throughout Europe and in England, this is not a static thing. We're going to start here, and the market is going to evolve over a number of years. So what's really important for us as private sector market participants is the fact that there is change in law relief or unforeseeable government conduct relief as well. So that's something that we're hoping to see in the balancing agreement and the participation agreements that are issued. Okay, so that's actually it from me. Are there any questions before I ask Keith to explain customer sources of supply? Okay, good. Do you want to come up here?
Yeah, so I think the concept of what happens for a customer comes down to one basic principle. We require that somebody is the balance responsible party for every meter point. So if you're a customer behind a meter point, someone is designated the balance responsible party. So it's either the customer themselves, they're balance responsible, or they have delegated it to a trader, or they've delegated to a licensed retailer, distributor to be balance responsible on their behalf. So when the customer makes choices as to who they're buying from, there always is somebody that's taking accountability for the variation. So if a customer thought they were going to be consuming 50 megawatts and 10 they're getting from trader A, 20 from trader B, the remainder from distribution, then when they do something different, distribution as the balance responsible party is going to be selling more or less based on what actually happened. And that becomes a problem if they want to now say, but they only want 20 megawatts from distribution and, and then they want to buy the rest on the market. That means that they have to become the balance responsible party, and then distribution, like every other trader, starts only allocating fixed megawatts. So when you're buying, you're not buying, it's not open-ended. because that would be the problem otherwise, because then you've got distribution, which is balanced responsible. You want to be balanced responsible. We can't have multiple balanced responsible parties. So I think that's just it comes down to that. So theoretically, as a licensed retailer, or what were we calling it? Regulated retailer, which I love the concept. I think that also makes a lot of sense. As a regulated retailer, they might also say, right, we're going to start doing fixed volume kind of deals that you can contract on a fixed volume, and then the customer could be a market participant and still buy from a regulated retailer as well as a trader. But it's in the basis where you've got to have that one person as balance responsible, and your contracting has to accommodate that, if that makes sense. Hope it's understood. So it just becomes an issue where you have lots of choice is all great, but there has to be at some point someone taking accountability for those choices. Okay. Cool, thanks.
Afternoon, everybody. I'm Andy Tant from Cresco, and as a bit of an aside to the main topic of today, just going to do a couple of minutes on a slightly different topic around broader decarbonisation. So I think probably most of the audience are aware of the work Cresco's been doing with major energy consumers in terms of developing renewable energy strategies and then implementing them, including looking forwards into what's happening to the future and how that will affect the financial position of that kind of strategy. What we've had in the last couple of years is more clients looking to us to develop a bit further than the renewable energy side of things. So for instance, on a typical mine, electricity might make up only maybe 50% or less of the total greenhouse gas emissions. So I thought we'd just talk through a little bit around what we've been doing in terms of that, in order to help clients meet their targets, as is normally the case. So what we've been working on and developing is sort of full spectrum decarbonisation modelling, which is really around looking at different combinations of technical and other commercial projects to take clients through to either a target level of decarbonisation or sort of full net zero position. This is really about looking at how you group these projects. They interact. It's not just a case of pure aggregation. All these projects have CapEx, OpEx, etc. We are focusing on the financial benefits of these projects, or otherwise in the case of some of them. But the ultimate aim of this modeling is really to help identify what is the best route to get to a particular decarbonisation target. What is the order which you want to implement these? How do they affect each other going forwards? So what's the best financial result? And also, to a great extent, what is the approach that will get you to a point where you still get financial benefits through decarbonisation? I think it's fairly clear to most people that despite what might be changing in the market, for instance, renewable energy typically is cheaper than energy purchased via Megaflex or similar. It's not to say that other types of decarbonisation projects have to be pure costs. There are benefits to this, and yeah, there's a lot to be explored in this space. Currently, we've been working on scope 1, so the on-site emissions, typically things like diesel combustion, emissions caused from process plants, explosives, that sort of thing. Electricity and utilities is obviously a big part of that for all of our clients. But scope 3 in terms of upstream and downstream is also possible. We haven't seen that yet as being a big part of the South African market. But going forwards, it's probably going to start becoming an issue as people get their heads around certainly the on-site and scope 2 emissions. So this is something that we've been excited to get into, helping some major mining companies get to a view of what it will take to decarbonize, what they need to do to get through that process. And really, I just wanted to say, if anybody is going down this path, we'd be happy to have a discussion and see how we can assist in terms of getting you there. So effectively, that's pretty much the end of it. Like I said, a quick aside, and yeah, I think it's the panel discussion is next. So Rob, if you can introduce that. Thank you.
Thank you very much. Thanks, Andy. A little bit of an aside, and apologies for the sales pitch. So it's past. We promised the panel will only be past because we're conscious 5 was the end. So if I can ask the 4 traders to come up, and if the gentleman from the back can come and mic them up, and we'll do the introductions while we're on stage with everyone. I don't know if the gentleman in the booth can come and connect on, please. Okay, self-connecting. The gentleman's coming now. Is everyone's okay?
There we go.
Oh, thank you.
Time to start. That too.
No heavy breathing, Duncan. Okay, thank you very much. So I'll let each of them start with a little bit of an intro of themselves. I'll say their names: Andre Negpin from Discovery, Duncan Abel from Envusa, Brett Yeller from Empower, and Precious from Africa Green Co. But perhaps you could start with in time 2 minutes from left to right, Duncan, going forward in terms of what each of your entities is currently doing. So I know you've had projects achieve financial close, where your focus is, and maybe 2 minutes on that. And if you could just work through, because I'm conscious that each of you are in very different stages of development in your business plan and your model development or business cycle development. So if you could start with that. Thank you, Duncan.
Cheers, thanks, Rob. Yeah, Duncan Abel from Envusa Energy. We're a joint venture between Anglo American and EDF Renewables. Currently, we've got 520 megawatts in construction. Really excited. We should be generating revenue towards the end of this year from our first solar PV projects, and 2 wind projects will follow shortly. Yeah, if things go to plan, we'll probably put on something sort of similar into construction beginning of next year, into next year, to sort of double that capacity to over 1 gigawatt. So things going really well on sort of developing our portfolios, giving us diversity from the project side. This year, our push is to go beyond our existing off-taker base, sort of beyond the mines, smelters, and processing plants that we currently got on board, and really to enter into what we're terming sort of the third-party market, and diversifying our portfolio, our off-taker portfolio. And I think from the sort of the presentations earlier, sort of 2 takeaways from that. As a trader, I think that diversity and that scale is going to be vital if we're going to be successful in the market. And then sort of secondly, probably a decision that we made was really good to have had Alex having oversight on our offtake agreements, because we know those change in law discussions are going to be fairly straightforward and seamless with our off-takers. But yeah, thank you.
No pressure, Alex. Cool, thank you. Andre, thank you.
Yeah, thank you. I probably should get Alex then to also look at ours some more and make sure we get those right. So thank you, everyone. Andre Negpin from Discovery Green. Probably, I think everyone never thought they'd see Discovery in the energy space, but here we are and excited to be here. We are a renewable energy trader, been sort of public for about 1.5 years now. Been working on this for quite some time. Received our license sort of at the end of last year, and been playing in the space, bringing a slightly, I think, different skill set and capability to this space, and hopefully adds a lot of value. So bringing a strong sort of mathematical approach to trying and solve the complexity and the volatility that comes alongside generation consumption. I think you all saw a Cresco slide with the ups and downs in a 24-hour period, and the talks about that 5%, you know, and the ability, I think, to manage that is something we do have skill sets in. So we're excited to be part of this market. At the end of a few years ago, we've started to enter on the procurement side of our projects, and they are imminent. And of course, we're very excited to have welcomed following news a number of new clients and partners in the space, hoping to deliver them energy quite soon. So thank you.
Cool. Thank you, Andre. Precious.
Thank you. Afternoon, everyone. My name is Precious Mpepele. I'm the commercial manager for Africa Green Co. We are an electricity trader headquartered in Zambia, incorporated in South Africa in 2022, and also recently licensed in October last year. Are the first trader to be licensed for cross-border import and export trading. So we're looking forward to the collaborations with Eskom and other customers on how we can increase regional integration for power flow. We also operate in Namibia, Zimbabwe, DRC. We lately in December incorporated in DRC as well. Thank you.
Thank you, Precious. Brett.
Afternoon, everyone. Brett Elo from NPower Trading. Yeah, good after the credible companies. I think we probably, still the smallest, trader from, guarantee perspective. We've recently, closed the SAPI deal, which was a massive milestone for our business. We should have some really good news, hitting the market in the next couple of weeks with some other kind of listed companies, which will be great for us. So from our perspective, we took our first kind of 150 megawatts from Solar Africa, which was a milestone for our business. We have the optionality to kind of take another 150, but from our aspect, we're looking at the other sources of power to come online. So we have respective term sheets from a wind perspective and various other sources. We've also applied for our SAP license for the import-export kind of aspect of the business, as well as the standard offer from Eskom. So, we, from our perspective as traders, our kind of core value prop sits in kind of off-taking power on kind of 20-year basis and looking at selling it into the market on kind of shorter tenors. So, the 5-10-year space is where we currently see our value prop from an aggregated source, with that hopefully coming down, over time as the market opens up. So from our perspective, we consult with Keith, we keep our ears to the ground, and as the market opens up, we look forward to seeing how the market progresses and hopefully playing a massive part in bringing kind of, power to the country, and increasing the GDP that the country so richly needs.
Cool. Thank you very much. So I'm just going to go in order of lines just because it's easier. So, I mean, Duncan, you were premised off the Anglo-American stable loads. Obviously, there's movement there outside of Envusa's control at the top. You might lose some, maybe you'll gain some. If you say you're going to do another 500, who are you going to sell it to?
It's going to be a combination. I mean, our existing off-takers, even though they might move outside of the Anglo stable, still have the same demand. I mean, we've put in place a structure which works for them. We've set up a financing structure which similarly allows us to just add new projects into the structure. So it's fairly seamless. So I mean, I think our ability to deliver is we'll keep them on board. What we're trying to do next, I suppose, is through demonstrating that we can add that scale to the market, is to diversify that portfolio. I mean, I think we're building a track record of being able to deliver our projects on time, to be able to deliver on scale, to be able to put in place contracting arrangements that work for multiple parties. Our ability to sort of switch sort of supply across different different off-takers across different portfolios to deal with excess energy. It's all stuff that we've had to do out of our existing off-taker base and looking to now sort of expand beyond those and offer the same service to other off-takers.
Cool, thank you. Andre, I mean, as you said, you're a bit different to the others. You have quite a different client base in your core business, non-energy, and you talked about balancing, preparing for that. So maybe you could just talk about what you've been doing, and then perhaps also transition or move. Let's not use the word transition. There's too many definitions in the energy code to the retail customer base where your other clients really sit. And I understand that you're an actuary, but apparently the most consistent curve in the world is the demand profile for residential users on an aggregated basis, right? So can you talk us through your view on how that will work over time?
Sure. So maybe important point, our real basis for all of this, I mean, a big part of our sort of entry into the space, actually, came back a few years when we tried to actually procure for our own operation. So, Discovery Limited has got some data centers, not a big user. It's definitely not as big as well, like a drop in the ocean for you. But when we looked at it, we saw that a couple of things sort of sparked out for us. One is the way it was approached was very much a one-for-one sort of relationship on that. And what that basically means is that all the volatility from the one side is transferred to the other side, and this party is responsible for managing that volatility. And as a result, what you used to see in the market, and you still see a lot of it today, is every single business almost, when they approach renewable energy, they're always talking 20, 30, 40% replacement of my current fossil fuel-based electricity with renewables. And the reason for that is volatility and the time of use distribution around that. I mean, we got an enormous amount of data, we got a big database on that, and we've modeled it out. I mean, it was quite eye-opening for us to realize very, very quickly that basically what you're dealing with here, there's an engineering problem, and then there's a mathematical problem. And the engineering problem, I think South Africa's got some of the best engineers in the world to try and solve and build these plants and get it connected and managing a lot of that. But when it gets put on, it's actually just, input and an output. And these are two very variable things. And our approach really was to say, so we've got an enormous amount of data. Let's look at that and see how we can manage that. So we currently, as I mentioned, we try to say, is there a mathematical way we can solve it? And the answer really lied, and this is what Keith sort of spoke up about today, about companies come together to be the balanced, responsible party of a portfolio. That's exactly the premise of our operation, almost to say, if you can bring together companies and bring about together diversification, this volatility mathematically just disappears. So our focus right now is, of course, in the corporate market. That's where we're focusing right now. It's where the offtake is. We're very surprised when you say the household is stable. We also look at a lot of corporates and we speak to corporates and they say, it's flat. Our consumption is flat. And then you get the data and you say, no, it's not. And you have to have that sort of conversation. There's enormous amount of volatility baked in. If you look at the generation side as well, there's enormous volatility. And so we're busy cutting our teeth on the corporate side. I mean, Discovery have got what, 8,500 corporate clients that we have strong relationships with in various forms on that. That's where we're focusing on right now. Is there a future for the broader market on that? Of course, we keep our eyes on that sort of horizon on that. But learning now as we go along to manage that risk.
Cool. No, thank you. I think to illustrate your point, you get the load. Exactly. It's a flat load. Then you look at it and you go, is that flat? And then you use 3 years data and every year is different. And you go, well, which date should we use? And then we had this thing called COVID where nothing really worked. So that's now an external data point, but I can feel your pain. Precious, you are an active participant in SAP, selling a few electrons, not as many as you'd like. Apparently trying to get involved in the balancing market there. Conscious that liquidity is quite small in SAP, very different to South Africa. But how do you see all for 1st of April 2026, the market's here? How much liquidity do you think we'll get based on your SAP experience?
Yeah, and I was happy when Keith presented a trajectory in the form of a roadmap, because I think it will be a transition where at the moment what we're seeing is each jurisdiction is trying to solve its own jurisdictional issues and capacitate themselves. But financially, all jurisdictions are facing quite severe bankability issues. And this is where the regional integration approach for us becomes lucrative. So yes, the market is going to become much more liquid because there is actually right now quite a huge demand than the market can supply. With instabilities, geopolitics, etc., private mining, let me say commercial industrial companies that find themselves in the region are looking to buy from the market as we speak, and the demand is quite huge. The liquidity is not necessarily a problem. The problem is getting the different jurisdictions to work and coordinate seamlessly. As we discussed, trading in the market requires prudency in terms of scheduling and imbalancing. And these are somewhat new concepts that actually brings a lot of psychological imbalances in some of our clients. But honestly, on a bigger scheme of things, imbalances, if you look at it on a system of socialized cost, it's really small. But there is that fear that, now I will incur these additional costs because of now being forced having to participate or having to operate in a market environment. But it's not really that material. I mean, a lot of independent generators that are operational now have built-in systems to really now know to almost a significant amount of accuracy what their performances will be. And it's only the new market entrants that are still struggling with the concept. And really that doesn't have the experience in scheduling with either supply or demand. And this is where we come in to say, we can take off that expertise for you. You don't have to worry about it. And we provide that cushion for the market.
Cool, thank you. So Brett, I mean, you brought up, I had a different question, which I'll say for a second, but the first question is your SAPI deal. And we talked about balancing. SAPI is an interesting client because they have their own generation. So your PPA and where you see it going with, and you can use SAPI as a placeholder, but the idea, how would you see your relationship continue with like a SAPI from a balancing point of view, considering they perhaps have their own generation? And do you think they look at that differently than someone who doesn't have their own generation?
Yeah, that's a good, very good
Sorry, I
question.
just thought of it now, so I didn't
think-
think.
Yeah, I think with regards to SAPI, obviously they have a very big load. So, from our perspective, we're probably supplying them with, maybe potentially 10% of their power. So I think from that aspect, it makes it a bit easier to balance loads currently. From the kind of on-state generation, we're hoping that we'll be able to facilitate the movement of that kind of dirty power into potentially SAP and into the market, especially with their kind of mandate to, reduce the carbon footprint. So I think, with regards to SAPI, it's probably quite a unique case. With regards to other clients, full models, a lot of the stuff from our aspect, or from our aspect, it's more from a commercial aspect. So I try to tell the power and work with the clients to facilitate the balancing.
Cool, thank you. I have more questions, but I'm going to open to the floor for any specific questions. So please raise your hand and we'll pass out the microphone. Okay, hopefully some will come. I'll go to you, Duncan. Integration between SAP and South Africa, you have loads in SAP. Some of them have interesting projects, some of them have regulatory restrictions. How is NERSA trying to match that with what's happening in South Africa?
So I mean, we do. We've got, operations in Zimbabwe, Botswana, and Namibia. There's sort of further sort of exploration opportunities beyond that as well. So we do in the future, we see ourselves as being definitely a regional player, watching what's happening in the SAP power pool, obviously watching what Greenco are doing sort of pretty closely as well. And we do. We see it as being one of the next steps for us to sort of start trading, I mean, sort of a cross-border. As I say, we'll follow our client base, and we do need to provide deep levels of renewable energy penetration across all of the operations, and not just those in South Africa. But there's a lot going on in South Africa at the moment, and that's where our main focus is currently.
Cool, thank you. Andre, 1st of April's here next year. Got trading for 8,000 people. How strong are your systems? I know Discovery is a very strong systems-based company, and you set up for this sort of mass data. You know, where are you in your thinking there? Because I think most of the systems is currently in Excel, but now, or whatever actually is used to model.
Yeah.
Where are you thinking there?
I think, and it's my understanding, but I think currently it's being done in an Excel sheet, being sent across to Keith, actually. I'm not too sure. But I think it is changing. So you know, these sort of numbers and these sort of, I think people overestimate the complexity really around that. I think with the market code, there's going to be an additional layer of that, but in terms of allocation, I think the bigger problem really is metering and the ability to get the information out on this. So, I mean, it's interesting that we've looked at a lot of different ones, and I think you'll find it's really the large companies that have sophisticated metering technology in order to facilitate that. And you're going to have to fix that first, and then work on the data, and then to facilitate the trades on that. So I don't want to put say that it's soon, but it is still a process in order to get to that point. I think virtual wheeling in particular is going to, once that platform comes in, is going to lay the foundation quite a bit for how we're going to do these transactions and take these forward. So I think that part of trading is the least concerning one at this point in time.
Cool, thank you. Precious, I mean, you've been a brand in SAP for a while, but you're quite new to South Africa. And a lot of people have, you know, Discovery have existing relationships. Duncan selling to his brother and his sister, you know, and Brett also has a few of those related parties. But how are you trying to catch up to the other traders, aggregators that maybe already have market share?
It's a bit of a chicken and egg, Rob. We actually have a lot more offers in terms of projects in South Africa than we have with customers. But we're happy to say that Sibanye is one of our pioneering customers, and we're looking to have a lot more relationships. But what we're seeing our role a lot more in terms of the current request is where a lot of customers have built their own embedded generations, or they have their cogens, and they're looking at what are opportunistic revenue channels they can use through our market access through the SAP. And that's one of the business model that we are pushing quite heavily now to provide augmentation for increased energy penetrations for the businesses that have already started with the decarbonization, and also in a future trajectory to look at this energy as a commodity way. It's, you know, it's a give and take, a sell and buy, where you're not only looking for just cheap electrons, but you can actually look at the trading models and the time of use and the market access opportunities, where you can then optimize and do tariff price arbitrage, let me say. So yeah, a lot of educational advocacy around SAP, how it works. But yeah, we'll get there. We'll catch up.
Thank you. Last question for Brett. We may have been involved in your South Africa deal. Value of BESS, where do you see that going?
That's a question for you. I think, no, I think based on our discussions, you know, we do see the value in BESS. Wind obviously hasn't performed as well as over the last 5 years. So we, you know, from our aspect, we're still looking at the next kind of, I suppose, renewable energy source to stack onto our current solar. We believe that BESS plays a massive part, especially from your you know, peak load shifting, whereas wind, you know, might blow off peak, etc. with the those tariffs still being pretty low. We think it's, definitely a value add that we'll definitely bring to our clients going forward. We just, hopefully we'll get access to a few of those projects in the next kind of, 12 months or so.
Cool, thank you. I'm going to ask again for any questions from the audience before I ask everyone just to make a closing comment. A very unengaged audience. Oh, we won, yay. Sorry, just the lady, if I can't see, just, he's coming down now, thank you. You can just stand and introduce yourself, please.
Hi, I'm Inga from Old Mutual. You alluded to virtual wheeling, and obviously one of the major concerns around that is just collections from municipalities. So has there been any further work done around solving for that?
I think that's for you, Andre. Yeah.
And I just double check. So I think we all understand the virtual wheeling is, I think, is a very clever mechanism, but of course we all recognize that the problem with it is it relies on the credit worthiness of municipalities, which, sorry to say, but is not in a very good public statement at this point in time in terms of the payments being made on this. But it doesn't mean that everyone is excluded. I think that's one point to do this, and it doesn't mean you can't try and innovate out of it. And I think there's some amazing ideas coming out now as ways to unlock a bigger part of the market. Will you be able to say, listen, 160 municipalities on day one are available? We haven't got a solution. I don't think there's a solution for that yet. But is there a big chunk of the market that someone will be able to take a risk on and say, listen, I'm comfortable taking the risk that there's a chance that the municipality might not pay Eskom, and Eskom hence might not pay you. I think the appetite's growing. It just takes time. I really, really think it, and I don't think it's far away.
Cool, thank you. Next question, please.
Hello, everyone. Charles du Plessis from Energy Partners. I think in closing, if the traders could maybe list the biggest challenges that they're currently facing in their respective areas.
Cool, that's a nice finish. But before they answer that, if there any one specific question, and then they can finish with that, is that okay? Cool, thanks, Zanele.
Good afternoon. My name is Zanele Mavusombata from Bambili Energy. I think my question is very similar to the one that was being asked. What is the systemic risk that you face? I think you're doing amazing, innovative work, but I think we need to talk to the risks as well. Thanks.
Cool, okay. Brett, we'll start with you. Just didn't want you feeling left out at the end. Do you want to start with systemic risk concerns?
Yeah, I think, back to the first question about challenges are definitely, we see massive value within the municipalities. We know that, everyone's chasing the bigger kind of deals out there. They are limited, even though they're 8,500 corporates. A lot of them are smaller. So from our aspect, really from our aspect, unlocking the municipalities from using the system aspect, very important. We're making good progress in City of Cape Town. We believe City of Ekurhuleni, City of Joburg, they're making good strides. But it is a risk because we don't know how long it's going to take for them to to unlock. I think the other big issue for a lot of these customers is from a guarantee aspect. A lot of our current clients are AA rated clients. The banks are very happy with these guys. The guys, the smaller guys who don't have the balance sheets in order to put up 6, 9, 12 months worth of guarantees. It's a massive issue. So how do we help the customers, from that aspect in order for, to provide them with cheaper, greener power? For a lot of these guys also, it's about, cost savings. So not necessarily, potentially the REX attributes, but from a savings aspect. So as traders, we, I suppose the thing that we focusing most on at the moment are how do we unlock more, smaller customers, because traders, we believe that's where our kind of core value prop sits in, the smaller guys, not necessarily dealing or competing with the IPPs on 20-year, deals. That's not where our value prop sits. Can we do, 3-5-year deals to guys that have, 1-2 megawatt loads, obviously, big also, that I think that's where the market will hopefully go, and that will allow us to offer more value to the market.
Thank you. Precious?
Yeah, I think I would say the rate of, or saying the pace of regulatory transition is what has been systemically a bottleneck. I mean, it took literally about, excuse me, 3 or 4 years before our license applications could literally sit in front of a regulator to adjudicate. That's one example. The other example in terms of municipality, the lady that asked about municipalities. Yes, South Africa is liberalizing, but we are seeing also in other jurisdictions where we introducing other innovative mechanisms to help those customers sitting behind units that may not be bankable or not even paying for the power by introducing the concept of energy banking. So that concept of energy banking has worked well for us as a trader, because then we are able to then use the market as a payment default de-risking mechanism. So if the utility is not paying, then we simply bank that energy and trade it when in the spot market, when the price are more sweeter, then we can recover our revenue through those mechanisms. I think that's something that the market can look at as we transition, Keith, to look at what other, but with municipalities, we'll have to also look at stringent criteria around who is eligible to qualify for those banking and who does the banking. Is it Eskom? Is it them? There's cascading impacts around the whole transactions. But yeah, there's ways to work around it. It will take time. Also from the banking side, I think for us to get the banks to actually endorse our model was a little bit of a challenge. Yeah, we did a lot of sounding with the banks in order to be able to bank projects in South Africa.
Cool. Thank you, Precious. Andre?
Sure. So a little bit of a different one. I think the biggest one, what we're seeing now is uncertainty, which is a little bit of an enemy right now. Businesses, I mean, unlike individuals, businesses are often run by committee, and everyone's always cautious to take the next step and take a decision on this. This is a new market. We've always bought electricity in one way, and now suddenly there's this whole, wheeling concept. I'm just now for our board, I have to explain what wheeling is like every 6 months. It is complex, it's new, it's uncertain, and regulatory certainty, like some of the things that have just come out now, helps. Increased certainty helps. The more people who do it helps, because people are followers. Not everyone's always a leader on that, and that uncertainty creates hesitation where, you just need one person to say, listen, I read in, the Huisgenoot magazine that electricity prices are going to, there's so much uncertainty in that causes trouble. And we often try to make the conversation with corporates to say, listen, yes, there is uncertainty, but let's approach this from just the simple ones and zeros. And we often do this calculation, I'll share it here, is to say, like, listen, if you delay by 5 years, you basically, the reason most people do that is say, oh, there might be this new technology, some people say fission. I don't know where that is, but that comes from, but it's always a new technology. But the opportunity cost of 5 years missing out on renewable energy, what does that mean? The cost of renewable energy needs to be in 5 years' time to justify you not taking that first step today. And we did that, I think we did that recently for solar and wind projects, and it said like every 5-year delay that you make, the underlying total price has to drop by 30% to justify that. If you look at the technology cost within that, which is usually about 2/3 of that, it means that, the price of solar panels have to drop by 50% for you to justify not taking the chance today. And we need to see more and more, we need to change that narrative. We need to get more people going, and the more people who take part, the more people will follow.
Cool. I mean, I can feel that. I mean, when we have a new client, the first slide is dispelling the myths, right? And then you start talking about real stuff. Duncan, will you take us home?
I mean, I think it's almost sort of to echo what Andre just sort of said. I mean, really, I mean, if we look back, I mean, I think the solar group had the first utility scale sort of PPA, and that is probably, I don't know, only 4 years ago, 5 years ago to push, and to where we've moved now. So in some ways, I mean, the market itself, call it the bilateral market, is in its infancy. Keith's moving ahead at a incredible pace and trying to get a sort of liberalized market in place in just over a year's time. We go through sort of fits and starts with sort of Eskom around sort of that sort of regulatory environment, around access to grid. The technology is changing all the time. We've got new market participants. I think there's sort of 10 odd traders in the market now. There are a number more who are sort of watching the space and readying themselves to enter. Each one of those has got a slightly different model. We're all making different promises to different clients around different things that we're certain are going to be the right solution for them. So, I mean, they are uncertain. I mean, your off-takers don't know sort of which is the right way to move, and trying to build that sort of confidence or instill confidence in what it is that you're offering. We might not be the cheapest. We might not offer you the most flexible terms out there, but we can deliver. I mean, that I think is the trick for all of us, is to try and take all of that uncertainty, try and sort of distill it into an offering that actually makes sort of sense, and that people can understand. It's a challenge at the moment. I mean, things are, as I say, in some instances moving incredibly rapidly, in others at a snail's pace, and then sort of things sort of changing in amongst that as well. But in saying that, it's a hell of a lot of fun as well. It's really, I mean, it's probably the most interesting space to be involved in South Africa at the moment. So yeah.
Cool. Thank you. That was a nice positive end. So I would like to thank our speakers, Keith and the panel. We didn't have gifts, but Alex offered a free consult, I hope. And then thanks everyone for joining. Hope you got some value from the event. As we said, if you registered, you'll get the slides and the piecemeal recording. I'm sure we can patch it together. But thanks again for your time on behalf of Cresco and Bowmans. Thank you. Have a good day. And sorry, there are drinks outside and snacks. So thank you very much.